What does 2013 hold in store for gold? We'll be getting Jon Nadler's thoughts up next. Thank you for joining us for this very special holiday edition of In the Lead. Jon Nadler now joins me on the line. Jon, thanks so much for being with us.
Thanks for having me.
Jon, let's start off by recapping gold's run in 2012. The yellow metal entered the year at around $1,600 an ounce in US dollar terms. Come November, amid all the volatility we were seeing, gold hit $1,713. That was a 12% increase from the beginning of the year. In euro terms, the price increase was also very similar. So, Jon, looking back, what do you think about gold's run this past year?
Well, Daniela, I think the year that was has largely been characterized by the obsession with the Fed and its QE programs. I think that's really what kept the markets on the boil. Expectations of continuing to infinity, and of course, I think the reality that developed later in the year basically showed us that the effect of QE on these markets has basically been one of diminishing returns. That each time the Fed did something or said something that was, indicative of monetary largesse, the markets responded in a more muted fashion each successive time. Aside from that, I think that the defining characteristic of the gold market, in particular for 2012, was the fact that physical demand appeared to really retreat, and that we were left with a demand side equation which was largely dependent on hedge funds, spec funds, and ETF accumulation activity.
Jon, you mentioned physical demand, and something interesting we saw here was the popularity of ETF demand increase in countries such as India, especially during times such as Diwali. Do you think that played an impact?
Well, there is, and India continues to present us with a conflicting set of paradigms, because the general trend in India this year was an overt effort on the part of the Reserve Bank of India and other official institutions to try to curb India's appetite for gold imports, because obviously they believe that this is one of the two principal contributors to the country's burgeoning current account deficit. So those efforts ranged anywhere from tariff hikes to, other schemes that they're trying to implement. In fact, the latest move comes from the All India Jewelry Federation, Trade Federation rather, which is proposing that country's denizens try to mobilize the staggering amounts of mattress gold and temple gold that is, resting in hidden places there in that country. Some estimates go for 25,000 tons. So they figure that even if 10% of that can be mobilized, somehow put into the market to work in other fashion, then of course the country could reduce its, $60 billion worth of gold imports per annum.
Jon, looking back over 2012, do you think it's correct to say that investors were really hinging on every word Bernanke said this past year in regards to quantitative easing and most recently the fiscal cliff?
Yes, and perhaps a bit too much, because, if we take the fact that China and India do still represent 40% of the physical global demand for gold, and that both countries underwent, a contraction in demand for various reasons, of course, China as opposed to India, we can't ignore that underlying, component of the supply and demand equation. The gold market continues to remain in a surplus of anywhere from 12 to 1,700 tons per year, and by some estimates, there needs to be a daily intake, and I mean every trading day, of about $500 million worth of gold that needs to flow into investment vehicles, be they hedge funds, ETFs, and what have you, in order to clear that surplus and not have the market, of course, clear at a different price. But yes, I would definitely agree with you that the overdependence on this Fed monetary policy, and of course the overdependence for many years now on the anticipated hyperinflation that would result out of these accommodative Fed policies has damaged sentiment to some degree because, the market needs to learn that it can't depend on single factors such as the Fed or at this point, of course, the fiscal cliff, which seems to be everybody's favorite word.
John, do you think it's also correct to say that as we enter 2013, one of the key drivers for gold, one of the overarching drivers for the gold price will continue to be this global financial crisis we're witnessing?
Well, the progress in the financial crisis, if you will, which we've seen this year take some strange turns. Of course, everybody was, assuring us of the fact that by now Greece would be, long gone from the EU. That somehow, China would have a hard landing as an effect out of the diminishment of European imports, and that the U.S. would not get its act together and not get back on track economically. Of course, none of these forecasts really panned out. China did contract and is definitely undergoing a slowing. We're just learning now that they're basically projecting 7.5% GDP growth next year, which is not bad, but certainly isn't the double-digit expansion rates that we've seen in the previous decade for that country.
John, let's talk about that coveted gold forecast now for 2013. I'd just like to say, however, that I don't think I remember seeing so many analyst revisions in regards to the gold forecast as I did in 2012. At the start of the year, many people were really calling for $2,000 gold, but as we neared closer to December 2012, a lot of them revising their forecast for gold. Most recently, we saw Goldman Sachs saying that they're not necessarily very bullish on gold for 2013, yet Morgan Stanley says it remains the commodity to watch. John, what are your thoughts?
Well, Daniela, where I stand is that I frankly don't care about the price of gold and where it might or might not go, because frankly, I don't buy or own gold for performance reasons. To me, what matters is the maintenance of a core, roughly 10% allocation to this metal as long-term, life insurance, if you will, for your other investments. But yes, I think opinion in this market has diverged, certainly after mid-year, to the point where there's, some would say quite conflicting trends in terms of where the highs and the lows that are being forecast are being put in. And, I've learned a long time ago not to really listen to mining company executives forecasting gold to the moon, because, of course, they've also promised us that their shares would perform by now, and, of course, they haven't. So I think the current shift in sentiment among forecasters and among trading houses is probably due, as well as we explained before, to this shift in sentiment that perhaps QE is not all it's cracked up to be for gold prices any longer, and that perhaps with the U.S. slowly emerging from this tunnel of economic difficulties, 2013 into 2014, that the dollar will benefit from this, and that the need for a larger crisis proportion allocation in gold perhaps isn't there.
John, I really need to ask you, because when I hear you speak, I wonder, do you not want gold to be higher?
Well, it's a motto that you probably heard from Adrian Day not that long ago, and certainly even from Ian McAvity. Be careful what you wish for. These are conditions, certainly the conditions that the fervent gold bugs, lay claim to, under which gold goes to the moon or to 2,400 or to 5,000 or to $62,000 an ounce, which are absolutely deadly to the rest of your financial life, to your portfolio, and to your social life, very likely as well, because we're talking about disruptions of the order of magnitude that would make life very difficult for most inhabitants in North America and elsewhere. So yes, I think people shouldn't necessarily wish for performance, given what classically gold has turned in as performance and under what conditions, because it is a crisis type of asset and it reacts to dire news, typically speaking. So stability in the gold price is, to my knowledge, after 35 years in this, how gold has built its reputation and its time-tested pedigree. In fact, it's a stable asset in the face of other assets fluctuating and being risk-laden.
But John, couldn't you also have a scenario where, yes, world uncertainty continues and gold rises in popularity as a safe haven of choice without there being an outright Armageddon necessarily?
Yeah, I think that there's a case to be made for that, but I think that case has been made, and it was made at the heyday of this crisis when I think the sky actually fell, specifically in the period between 2008 and 2010. That, to me, was gold's best shot at vindicating the inflation-adjusted price tag, if you like, and rising to $22, $23, $2,400, whatever it was at the time, because in fact, every single headline, every single day told us of the dominoes that were falling in the financial world on Wall Street, and then Europe tanking, and of course, Asia slowing down as a result. So I think that the worst case scenario has come to pass. And yet, here we are, celebrating the holidays. And of course, other than the fact that Friday might be, in fact, the world's end, according to the Mayan calendar, hopefully we will regroup here in about a month's time and do a recap of 2012 in a different light.
On that note, Jon, if it is the end of the world, it was a pleasure knowing you.
Absolutely. It was my pleasure to work with you too, and we'll see you, in another universe, in another life.
Jon, thank you so much for your thoughts. Obviously, no one knows what the future holds, but we can all hope it will be bright.
I can tell you one thing, the future holds hopefully a pleasant and happy holiday for all of our viewers, and a happy, healthy, and prosperous 2013 for all of us. And with that, I bid you farewell until next year.
Thank you, Jon, and happy holidays indeed to all of our Kitco viewers. Thank you for your support throughout 2012. We wish you a very happy and healthy holiday season. All the best.